Hi, everyone, and welcome to another episode of Pulse Point by Synpulse. My name is Jenya Tkachenko, and I'm also the host. And today with us, we have Cameron Howe from Investipal. Cameron, welcome.
Yeah, thanks for having me on.
Yes, of course, anytime. Would you like to give a quick intro about yourself and what you do?
Sure. Yeah. So I am the CEO, one of the co-founders of Investipal. We're building a AI-enabled portfolio manager. So what that means is, I'll give you a quick background. Actually, I used to be a quant, and both buy and sell side. So I'd advise clients on how to think more quantitatively, and then also manage the quantitative ETF. The downfall we always had that AI has helped unlock is we would only run black box models. So no one knows why the system spat out what it did. Our whole goal is to equip advisors and investors with those quantitative tools so they can invest more methodically for their clients or for themselves. And then with that, there's a big explainability piece. So it's unblack boxifying that model, and you can understand all the rationale that went into that decision.
What was it that propelled you to start this company, and how did you notice this gap in the market?
It started back in 2021. There was the big influx of retail investors we saw with GameStop and Reddit, Wall Street Bets, and all that. So I had a lot of my own friends and family reaching out, Cam, what should I invest in? I want to get into the market now. I have no idea what I'm doing. So I ended up leaving the bank and co-founded it with one of my high school friends, Abdi, where we were originally a D2C company. So we were helping that end retail investor out with some of those more sophisticated tools. I think we were a little too early on that. While we tried making it as simple as possible, it's still quite advanced for like that general retail investor. So we ended up evolving over the past, 14 to 16 months now to move away from that retail channel for now to focus on the wealth channel because the same problems that are afflicting the retail investor are consistent with how investment advisors should better service their end clients.
Mm-hmm. And how do you see the role of the advisor evolving into a more holistic situation where they're providing advice beyond the general scope of what used to be traditional?
Yeah, it's honestly been very fascinating so we deal with advisors in Canada and the US. And the big trend in the US is this RIA model where they're breakaway advisors or advisors who are coming to this industry, they're deciding not to go with a big firm. They're deciding to basically open up their own shop. And you have to think, why is a client picking Joe Schmo, who's running a local branch of his RIA, versus wanting to go with one of these big institutions? And I think it's the level of service that they're able to provide. You know, before you'd have to go get your CFA or you have to go get like your CIM in Canada, and your value is positioned around picking stocks or building portfolios. But where that big shift is coming is that end client wants more. The democratization of investing, whether it be through platforms like Wealthsimple to do that robo advice or like a Robinhood to offer $0 trades, that advisors now had to evolve their service offering and be much more involved in their client's life. So that's where you see like the planning coming in, the taxes, estates. And I think where you're starting to see that evolution happen is those bank level advisors are adopting that mentality. Before it would be, there's someone on my team who does planning. But now what we're seeing is instead of getting my CFA, I'm going to get my CFP. And I'm going to be a planner first. And the investments are a tool to accomplish a goal for my client, but it is not the main value I'm going to market with.
What do you see are the general trends of value that advisors are providing to their clients?
So we have this thesis that the next several years, if not the next decade, we're going to see the advisor, if they already haven't, shift towards this financial therapist / financial coach mentality. And what that means is a AI or a robo is not able to understand the emotional impact that you have with your money. I think that's really where we're going to see the advisor evolve, is this financial coach where you can bounce ideas off regardless of what it is. So instead of just calling them up to talk about investments, you can talk to them about, I'm thinking of having a kid, I'm exploring going back to school to get my master's. and then being able to not just focus in on an outcome of here's what I want to invest you in, or here's your financial plan. It's really taking that personalized approach to how we think about your overall financial well-being.
Do you think that there is a certain type of person, or do you think that there's like new characteristics that need to be developed, provided that now we're shifting more towards like a financial therapist type of role?
Definitely the human side. I think first and foremost, the investment advisor is a relationship manager. And if they don't think that, there's other people out there who've expressed similar strong opinions on this, but if you don't think that you are a relationship manager first and foremost, you're probably not doing a great job, because you do have to understand a lot of that client nuance that isn't discovered by giving them raw numbers or looking at the raw numbers. You actually have to take the consideration of the behavioral characteristics, what is their emotional attachment to money, and using that to help with those outcomes, which whether that be the investments or whether that be the actual investment plan. So suffice to say, I think that core thing they have to develop out is that relationship manager mentality, and moving away from this like transactional based model that they would have been if you've been in the industry since like the 90s or early 2000s.
And generally for wealth leaders, given what you've seen in the industry, of course, aside from what we just talked about with emotional characteristics, what kind of trends are you seeing that are on their agenda in terms of challenges or what's keeping them up at night?
Good question. When I chat with, let's say, like C-suite folks at like big banks, I'll use like the U.S. side. They don't view the RAAs as a threat necessarily, because at the end of the day, they also have their bank accounts, they have their mortgages, they have everything under one banner. So they can be a little bit slower moving in terms of how they respond to the market. And I think what you're seeing is they're taking a pulse on like where that traction is in the RIA segment. Like you look at companies like Ritholtz and what they're doing with like social media and creating that engaged following, where now the client has an attachment to that firm and that's why they're winning business. But then you have these challenger banks that are coming up, and the younger generation isn't necessarily as attached to that brand, like to that big five bank or to like that wirehouse in the US. So they are taking a slower approach, but they are paying close attention to like what is developing in the market, knowing that they're not going to be as risky as an individual RIA or some of these neobanks will, but they are starting to evolve that service model to have more of that relationship manager mentality, and you see that taking the form around a big emphasis on financial planning now.
I want to pivot back to you starting your own business. What have you found to be the biggest challenges and also the biggest successes?
The biggest challenge was we built a product that we thought we understood the market on, and you build it up, you try to sell it. Then you say, okay, these people didn't like it, so they're not our fit. We have to go back to the drawing board and find new customers. And it was like a sales focus. Like, we have a product, let's go find the market for it now. The big pivot that we made was let's abandon all of that. And the clients that we do have, let's take a very nuanced approach in what are the other pain points that you're experiencing? And is that something we want to get involved with helping to solve as well? Or is that better serviced with like another technology provider, or maybe not technology at all? So there's a lot of hardship and pain in the entrepreneurship world. You're doing it alone essentially, and you have to figure all that out for yourself. So outside of that, I'd say the big pivot that we've taken internally that's helped improve the business and improve the way that we think about things, which may sound corny, but we do try to partner with all of the clients that we bring on board to see where are the other pains in the business. I'll give you like a good anecdote. We had this client risk assessment that feeds into a portfolio review. And one of the firms we were trying to sell to said, I spend a lot of time on manual data entry. It'd be really cool if I could just upload that client account statement, scan all that information, and it does the portfolio review instantly for me. So we built that out. We started to market it a little bit, and then all of a sudden you see a bunch of marketing leads come in. So it's not the sales team going and reaching out to people; it's just organic traffic into the business. That was super fascinating to see. And then you start to see some of our other competitors replicate that, and then you're like, okay, cool. Like we're actually making an impact on the market here and really trying to solve advisors' time. Because if we're doing it and our competitors are starting to do it, it's clearly a massive pain point. But we weren't able to get there until we really started to listen to either our existing clients or through some of our sales discoveries, really where those pain points lived.
So Synpulse actually partners with many vendors or big banks. From your experience, what leads to a successful partnership, and what are those characteristics of good work?
I am a believer in karma. And what I mean by that in the case of a partnership is if you can try to help out another business and not expect anything back immediately in return, hopefully that will come back to help you. So like we partner with a lot of different firms, whether that is consulting services or whether that's other vendors or just other people in the finance space, because there's that mentality on what is the difference between a millionaire and a billionaire, and the billionaire mentality is I want to help other people get rich. I'd say that's the mentality that we've had with successful partnerships is if we think we can help them out, let's try to do it out of the gate, and hopefully we get something back in return. And the value we get out of our partners is they have the same thing for us. We might be too early on for some of their discussions that they could bring us into conversations with, or we're not an immediate fit for. But if they can start entertaining us in some of those conversations, then that helps our business out, and then hopefully in the future we can return the favor to them.
So in terms of your future outlook and what you see happening in terms of the next decade or so, what is the factor that you think will redefine the relationship between clients and advisors?
That higher level of service is, I think, a must now. And if you're not there, you have to be, or you're going to be out of business in the next several years. So that takes the form of evolving your practice to focus more in on those other elements away from just investment management. That is what we focus in on, but that's a means to help automate the advisor so that it frees them up to focus in on more of those other areas. And then within that, you see other trends like the stock market has never been as highly correlated as it has been, concentrated amongst a select few. And we've seen that, the time of recording, DeepSeek news came out over the weekend, and like Nvidia was down. I don't even know what it's at. It was down 16% on Monday.
Something like that.
And that's dragging the S&P and the NASDAQ down because of the market cap concentration risk. So you're starting to see this intertwining of correlation amongst where all the passive flows are. And then you start to see fixed income being linked into that. And bond prices are historically supposed to trade inverse to the stock market, but then in periods of stress, we've seen them become correlated. So we're starting to see that advisor evolve away from just public market securities into alternatives as a means to help de-risk their clients and provide that long-term wealth plan for them.
So how do private assets compare to private markets in terms of risk, et cetera?
So apples to apples, if you're comparing, let's say, like a private real estate fund to a publicly listed REIT ETF, there's not going to necessarily be a ton of difference between how those securities interact. The only difference is that ETF is being priced daily, and the private has the benefit of not being priced daily. So you could see that back in 2022 when the stock market crashed, and the lagging indicator was the VC and private equity markets, which started to take haircuts on valuations just because they're not being priced as much. But on the private side, you have a much wider breadth of offerings. You have private equity, you have infrastructure funds, you have more niche real estate offerings, you have hedge funds, you have, the list goes on and on and on. So as such, you can build a much more diversified portfolio than what's happening in the public markets. I think if you see a trend of companies going public again, companies like ourselves, we historically would have been on like a 5 to 7 year pathway to go public. Now we don't have to anymore, and we don't want to because of all the excess compliance and regulation and costs that incurs. So you see more companies remaining private, but there's still a lot of good opportunities like Stripe and whatnot have, I believe, no real plan to go public, but how can you still access high growth companies? How can you access these different asset classes? So I think with that breadth of offering, the advisor has a more difficult job now of how do we evaluate all of these different products. So there's that apples to apples comparison, but now you have to think through, because I don't have all this publicly available data, how do I think about constructing a portfolio for my client and what products should I offer them? I had a fascinating conversation on my own podcast with a guy who used to do this for pension funds. And the big thing he left me with was just looking at realized versus unrealized gains. And if your fund manager is booking a ton of unrealized gains in their portfolio, they could artificially be inflating the value of their positions, versus if it's realized gains and they're actually returning capital back to their clients. That's a pretty good indicator that this is a true reflection of returns or income, what have you. And I'm going to rank that higher. So you have to take more of a methodical approach, I'd say, instead of just looking at the financials of a company and starting to look at more of the characteristics behind the manager. So like, what is the track record of the team? What are they doing to provide as much visibility and clarity into their fund structure and how they're going to end up returning capital back to you? There's also a whole nuance around liquidity and liquidity needs behind my clients. And when am I expecting to get that back? So I'm starting to see more of our advisor clients focus in on like open-ended funds or having quarterly liquidity events where they are able to get that money back, so that liquidity trap doesn't become an issue for their end clients as well.
Mm-hmm. And I guess broadly, if you were to bucket the thought process of these teams, these advisors, what are the factors that they should be considering for when selecting these types of assets for their clients?
Yeah, I think there should be a strong emphasis on that track record. Back in 2021, 2022, in the public side, we saw that big SPAC craze where everyone in the industry, if they had some notoriety, was going to launch a fund. We've seen that in the private equity world where no disrespect to her, but like Kim Kardashian comes out with like her own private equity company. Is she the actual best manager behind that? Probably not. So like looking at a lot of those nuances on like, have they been in the industry doing this a while, or is this more of like a get rich quick scheme for them? And if you see a lot of money pouring in very quickly to a space because of media or social media, probably a good indicator to avoid that. So that track record, which is a bit of a qualitative metric, but you can also see that coming through on the historical timeline of that return profile. How many funds have they had within those previous funds? What sort of liquidity events have they had? Let's say on the private equity side or the venture capital side, have these companies actually gone on to go public, or have there been some sort of massive liquidity event? Or is it essentially just shifting one of those portfolio companies from one fund into another and artificially creating those returns, but it's not actually hitting the bank account of that end client?
Mm-hmm. And so let's say that there's a new client looking to get into this space. What's the best way for an advisor to educate them on these potential pitfalls and traps?
That's a very good question. We've noticed a lot of teams starting to specialize in it. So I think if that advisors making it a core focus for their firm, so you could take core focuses on we're planners first, or we've really focused in on estates. We have one client, all he services is manufacturing distributors in the US, and they're able to take that really niche approach. And they'll end up either trying to do some of the investments on their own, or what we see the good ones do is they understand their value is on that market and they'll subcontract out to other firms. So I would, when you're having a conversation with your advisor and you want access to some of these products, I would understand, is this a core focus for the firm? And if it's not, how are they going about thinking about privates? Is it something that they're looking at owning? And if it's both cases, it might be more of a red flag. If they are making alts or privates a core focus in terms of their offering, I would spend a lot of time to figure out their due diligence process for evaluating these fund managers, so you can gain comfort that they do have your best interest in mind. Because what I would mention, one of the big differences between the publics and the privates, there's still a lot of fees on the privates piece. And are they offering privates as a means of diversification or as a means of enriching themselves?
It goes back to the financial therapist topic we spoke about earlier.
Yeah, exactly.
So let's talk about your future outlook. I know we talked a little bit about trends over the next decade or so, but I'm curious to know what technology you're most excited about.
Definitely AI.
Of course.
I would caution, though, that that is a catch-all term. The way that we think about it, there's the generative AI, so the ChatGPTs of the world, which are getting all the excitement. Where we really focus in on is more on the deep learning side. So back to that original point on what we're trying to do, we're building out that explainable AI model to construct portfolios that align to your client's goals. So it's essentially a bit of a buzzword now, but that personalization at scale. How can I ensure that my practice can still scale while offering that more personalized advice? And that we weren't able to get there before because the infrastructure was not put in place, but now we can. And we do have like ChatGPT and OpenAI to thank for that because of the focus that cloud services like Azure or AWS, they have this as a massive component within their cloud stack that we can capitalize on for a lower cost. So I'm especially excited on that deep learning aspects because Gen AI is good at text-based answers, but it's not good at math. That's really where that deep learning comes into effect is we can now design more advanced portfolios that align to those client goals. And then we can always pass that back through an LLM to actually give that black box model into a white box model where we're giving you all that context back. So that's really what excites me. And then on that qualitative aspect, what excites me is seeing these advisors evolve off of that stock picker or portfolio manager to be more of that financial coach and therapist for their clients. Because at the end of the day, we want to see the client's best interest in mind, and we want to work with firms who have that same sort of mentality.
At what point do you feel like technology will not be able to replace the human connection?
I think in 10 years, it's tough because we've seen, ChatGPT's been out for a few years and how much that's been involved in our day-to-day lives already. I don't know about you, but it's pretty involved in my life. I think the younger generation is going to be that catalyst. They're usually a bit more introverted. They don't want to necessarily talk to one another. I think that will be the catalyst for seeing a shift of advice potentially away from a human to a human AI interaction. But at the end of the day, I don't think an AI is going to be able to have that as technology stands today, have that actual human connection point. And I think there's always going to be a human involved to some extent, especially when it comes to finances, which are so personal to people.
Mm-hmm. And talk to me more about this personalization at scale concept and why it's so important to you.
It's a natural trade-off. If you want scalability, you can't be as personalized historically. So you could think of the shift from like discretionary portfolio management to models. I'm now bucketing people into certain risk categories, and I'm going to be assigning them a model because I can still scale my practice up. But this shift towards that greater level of personalization, I'll talk about the investment management side because that's where we focus in on. The advisor's now spending a ton of time figuring out your financial plan, what your goals are. Do you need help with taxes? Do you need help with your estate and your wills? And we're taking this very holistic view. Where we see that gap, though, the portfolio management side is still this one-size-fits-all approach. So how can I take all of that data that I'm getting in the financial plan, in the tax preparations, in the estate, to now inform the portfolio selection? Because the portfolios at the end of the day are just a tool. They're helping achieve the outcome of the financial plan. So that personalization at scale is the way we think about it, is how can we use some of those more personal aspects to inform the portfolio decisions but in a way that you're not having to spend as much time figuring out all the nuances that discretionary portfolio management brings. So you could think of it, the best of both worlds is what we're trying to do, is unlock the scale that model portfolio management brings with the personalization that discretionary does.
What are your favorite tools that teams are currently using in order to achieve that goal?
In terms of like our own like day-to-day tech stack.
Sure, yeah.
So we have been able to keep a pretty lean team because we leverage AI in our software development quite extensively. Claude has been like our go-to for that. We've tried out a bunch of different tools. Google seems to be coming up with, like Gemini seems to be a pretty good one when it's fully available in Canada. But Claude has essentially, I'd say 3x our developer headcount with like a $20 a month subscription. And that only continues to build. Like I think Sam Altman came out recently and said when we launched ChatGPT 4, it was ranked as like the 100,000th best developer in the world. 4.0 was like the 100th or 1,000th, and the new model we're creating is in like the top 10. So you're seeing like a very short time frame. Teams like ours are able to build out products a lot quicker with the help of AI. I can tell you as someone who does development myself, it's definitely not up to snuff yet, but it is certainly coming. And then we're seeing advisors in their day-to-day, like we have that tool I mentioned before that can scan documents and automate the manual data entry. The value for them is if the advisor is the one managing that, they're saving a ton of time on low-value tasks. If they're bringing on client associates, they necessarily don't have to scale that team out as much. And then you're also seeing the flavor a little bit on like meeting note takers. There's a lot that have come to the market. I imagine at the end of the day, Zoom's built in or Teams built in ones will end up winning out. But you're starting to see, you and I can have a conversation and I can go look back at our call notes and take those key points home for when I go to actually create a proposal or need to make any changes to your plan. So it's allowing us to focus in on a conversation instead of me having to take notes throughout the entire discussion and getting distracted.
So how do you think the roles of people on your team are going to evolve given the speed at which this technology is coming at us?
I think there's a very close parallel between how we operate and how we're seeing that advisor operate, which is on that relationship manager aspect. Our sales team has a direct feed to our development team to keep those feedback cycles very tight. Because before you'd think my sales team is always going to promise or say stuff to clients that's going to get lost in the weeds, or it's going to get put on a product roadmap that never really gets actioned. But now with that AI coming into the folds, we can have those very tight feedback loops where if it's like, hey, these guys want one feature tweaked. Instead of putting that in a 2-week sprint, you could have an AI generate it for you within 20 minutes and you might have a very quick fix out. So our sales team is moving more towards this consultant sort of model where it is trying to work hand in hand with our clients, and we can build more bespoke tools to help service them at a much quicker clip than would have previously been achieved.
And so in that case, for advisors in general, what is your vision as to what might happen and how would you recommend for them to best stay ahead of the curve?
I think it would be super fascinating end state-wise where, I'm your advisor. We sit down, we have a discussion. You confide in me all of your financial gripes and where you're looking to head, and I can be focused in the moment. My note taker can distill out all those key points. That can get fed into a system like Investipal to help create your investment plan. It can then get fed into your financial plan to help structure all of that. And by the time I go sit back at my desk again, I have everything built out for you, and I can go provide that overlay to make sure I'm taking more of that human nuance into consideration. And then tomorrow we can sit down rather than 3 or 4 weeks from now, and I'm ready to win your business, move you over, or if you're an existing client, to actually be able to action and deliver that service to you. So I think that service delivery feedback loop, getting that down to sub 1 day would be absolutely fascinating, and it's something we're trying to work towards unlocking for advisors.
And Cam, just generally, broadly, whether that's a trend, technology, what are you most excited about?
Yeah, I'm most excited about building this Robo 3.0 out. What I mean by that is Robo 1.0 is this wealth simple sort of model, or name your robo advisor, where it's doing this risk bucketing. You know, you're going to do a risk assessment. We're going to put you in these models and set it and forget it. The Robo 2.0, I'll call it more on the advisor side, which is leveraging like TAMPs. So leveraging like outsourced portfolio managers to take a little bit more flexibility in how we think about portfolio management, some more advanced products within it. But what we're trying to build towards is that Robo 3.0 model, where we can do an assessment on you. We'll understand your risk, your goals, all those considerations we spoke about before, and deliver that portfolio, but then take also a proactive approach to do the ongoing monitoring and rebalancing. Some would say that's direct indexing, and I would say it's not. The direct indexing side is usually, instead of owning individual products like ETFs, we're just going to go direct and own the S&P 500 root holdings altogether. Our viewpoint is that we can tailor each individual portfolio to those specific clients. So if you're interested, let's say, in ESG, or you're interested in, you know, companies that focus on fashion or something, let's say, we can take some of those nuances into consideration and build you something very bespoke. And then rather than you or that advisor coming in, having to monitor the performance or sit down with you, we'll proactively alert to say, hey, you know, we've noticed, you know, LVMH is starting to show increased risk signals. We think you should probably trade this security out and switch it with another fashion stock, or like move away from that entirely. So it's essentially automating all of that portfolio management function for an advisor or that end client. And what I think we'll see, because we've started to see some of those big wealth firms shut down their robo advisors, I think we will start to see a model where the direct-to-consumer comes back into the fold again, because that portfolio management aspect is not the main value that advisors are offering clients, and they can focus that time and attention on more of that relationship element. So that piece is what excites me the most and keeps me motivated, is building this more bespoke portfolio management solution out for whether that's D2C or advisors.
And last question for you. So Synpulse is a financial services consulting company. So given the way that technology is evolving, and given, you know, all these new projects that may or may not come up, where do you see partners such as Synpulse delivering the most value to companies like Investipal?
I think a lot of it lives with helping these firms move away from legacy solutions. So I think a lot of these firms invested in a tech stack in the 80s and 90s, and they did some modernization along the way, but they haven't really caught up to speed with like what we're seeing in the RA market. And, you know, like I said before, the banks that we've spoken with, they're taking a slower approach with it. But they are becoming more scared, not on the RA side, but on like the challenger banks, more on the discount brokerage side, more than anything. I think there's a lot of coaching that can be done around what does that end state look like, and how do we get off some of those legacy solutions that haven't been maintained or haven't caught up to speed. Like, at least in Canada, a lot of them aren't able to offer fractional trading. And that's not because the discount brokerage firm doesn't want to. It's because their underlying technology provider that they use isn't able to offer that to them. So they're stuck. But because they're stuck, their clients are now going to move over to a challenger bank because they're able to offer that. So I think it's a lot on the vision piece is where I think Synpulse can help out, is how do we help you get to that end state and regardless of the technology, what do you want that to look like? And how can we help build up that roadmap to get you there in the next 5 or the next 10 years?
Well, Cameron, really fascinating stuff. Thank you so much for your time and being here with us today.
Yeah, thank you so much for having me on today.
Yeah, absolutely. And it's good to know that the human touch isn't going away from wealth management anytime soon, and really excited to continue to look out for whatever you continue building.
Yeah, thank you so much. Yeah, I don't think it'll be going away anytime soon.